Making money is great, but if you don't know how to reduce your taxes, then as you climb the tax brackets, you're going to owe larger and larger sums of money to the government in the form of taxes. For top earners, total tax burdens can be as high as 50% or even more in certain states. Do you really want to work so hard to get ahead only to give half of your money to the government? I don't think so. Well, in today's video, I'm going to break down 5 of the best tax deductible investments that can make a dramatic impact on reducing your overall tax bill. If you're tired of having an extremely high tax bill, then this is the video that you're going to want to watch. Without further ado, let's dive in. All right, guys, what is a tax deductible investment? A tax deductible investment is an investment that qualifies for a tax deduction. A tax deduction is an amount of money that the IRS allows you to subtract from your taxable income so that you don't have to pay tax on it. So tax deductible investments help you reduce your taxable income. The more that you can reduce your taxable income, the lower your taxes will ultimately be. Okay, now that I covered what a tax deductible investment is, let's go over the 5 best tax deductible investments in 2024. Number 1, real estate investing. Real estate can include single-family homes, multifamily, condos, apartments, and even storage units. Real estate offers incredible tax deductions. For this reason, it has been a prominent investment of the wealthy class for generations. The tax deductions of real estate investments are so powerful that many real estate investors are able to bring their taxes down to zero or close to zero by investing in real estate. Some of the best tax deductions that real estate investors are eligible for include property taxes, management fees, advertising, mortgage interest, the insurance premiums that you could be paying on your mortgage, repairs, travel, as well as depreciation. However, while all of these real estate tax deductions are beneficial and can help you reduce your taxable income significantly, it is the depreciation deduction that often helps real estate investors to save the most amount of money in their taxes. Depreciation refers to the wear and tear that your structure will experience over time due to things like rain, snow, sleet, hail, as well as tenant damage. The government allows you to deduct the entire cost of your structure over a certain period of time to account for depreciation. For residential properties, this period is 27.5 years, and for commercial properties, it is 39 years. However, even though that the government allows you to deduct depreciation costs for the full value of your building, it doesn't mean that your building will be worth $0 in 27.5 or 39 years. In fact, if the building is maintained well, it will most likely be worth more significantly over that period of time. Also, you'll be able to collect passive income during the property's useful life as well. So real estate investments help you to build wealth through property appreciation and rental payments. And they also help you to reduce your taxes through depreciation and a wide variety of other tax deductions that real estate investors qualify for. The depreciation deduction by itself is so large that it often offsets the entire amount of rental income that the real estate investor receives for their properties. You can also accelerate depreciation with the help of a cost segregation study and take a larger percentage of your entire depreciation deduction within the first 5 to 7 years of owning the property. In addition to using the depreciation deduction to offset rental income, you can also use it to offset 1099 or W-2 income if you meet certain criteria, such as having short-term rentals as opposed to long-term rentals. The bottom line is that real estate is one of the greatest tax deductible investments currently available to US taxpayers. And look, if you're going to follow my strategies this year and purchase a short-term rental to offset your taxes and to begin the process of building generational wealth, you need to get organized in the way to find deals and to manage properties. Listen, deals aren't just going to come to you. You need to search for great opportunities with houses that perform well in cost segregation studies. You need to get on the phone and you're going to need to make things happen. But you can't call like an amateur on your personal line. If your personal line is your business line, you're going to be making a lot of mistakes early on. Picking up the phone like an amateur, you're probably going to lose out on deals. That's why I want to tell you about our sponsor for today's video, Nextiva. With Nextiva, you can create phone numbers in different area codes all through the United States. So if you're a real estate investor like myself, dialing for deals, Nextiva will help you get more answers with phone numbers from the area codes that you're calling from. You'll get unlimited calling, you'll get unlimited business texting, and you'll get auto attendance, voice analytics, and many more features that will make your business look as polished as a Fortune 500 company when you're calling people. And once you start managing those short-term rentals, because I know you want to, being the most active person in your business, you're going to need tools to communicate with all of your tenants. That's why I recommend Nextiva, because Nextiva lets you manage all of your conversations and all of your teams with one easy to use app called Nextiva One. This means that there's no more switching between a dozen different applications to get the job done. Don't let an amateur business setup hold you back in 2024. Make a small investment into your business and yourself. I'm going to show the link below on the screen so you guys can check it out. This will help you to get 50% off of your plan, all linked in the description below. For my members who watch on my channel, you guys will all qualify to get 50% off, and you can talk to a Nextiva rep to see if it's the right fit for you. Without further ado, let's get back to this video. All right, guys. Number 2 is oil and gas. Just like with real estate, the government provides an array of incredible tax deductions for oil and gas investments. And this is because, like real estate, oil and gas are both extremely important for human survival. Whereas real estate gives people a place to live, oil and gas helps to provide energy that is needed to heat homes and businesses and to even fuel our vehicles and much more. I mean, think about it. Without oil and gas, millions of people would either freeze to death or wouldn't be able to use their car, trucks, or airplanes to go from point A to point B. So it makes sense that the government would create some major tax breaks for people who invest in these sectors. There are several key tax deductions for oil and gas investors. So let's take a look at some of these tax benefits. Number 1, the government provides tax breaks for both intangible and tangible drilling costs for oil and gas wells. And I'll explain the differences. Intangible drilling costs are all of the cost involved with drilling except for the actual drilling equipment. So for example, that includes the labor, the lease costs, mineral rights, logging costs, survey, drainage. Intangible costs cannot be recovered, but they are necessary for the drilling operation. And these costs usually represent 60 to 80% of the total cost of drilling a well, and they're 100% tax deductible. Tangible costs are the actual cost of the machinery and equipment that is used to drill for oil or gas. These costs usually make up about 20 to 40% of the total cost of a drilling operation. They're also 100% tax deductible. However, they have to be depreciated over a period of 7 years. So between the intangible drilling cost and the tangible drilling cost, you'll be able to get a tax deduction for the majority of your entire oil and gas investments within the first few years of making the investment. Also, keep in mind that oil and gas investments generate cash flow, just like rental real estate. This is because oil and gas gets extracted from them over a period of years and are then sold for cash. The cash then gets distributed to the investors. So as long as the well is still producing, you can generate cash flow. And guess what? There's another great tax benefit from this cash flow. Small producers are eligible for something called the Small Producer Depletion Allowance. This allowance excludes 15% of the gross income from oil and gas wells from being taxed. This means that 15% of the cash flow that you would receive would actually be exempt from tax if you invest in a small producer. It's pretty cool, right? Now, there are many different ways to invest in oil and gas, including mutual funds, partnerships, royalty interest, and working interest, but the tax rules vary slightly for each investment type. For certain oil and gas investments, you can actually use the losses to offset your W-2 or your 1099 income. I'm not going to dive into all the details of that rule today. I'll cover it in another video. But at least for now, I want your mind to start thinking about how oil and gas could be an incredible tax benefit to you as an investment to reduce your overall tax burden. Number 3, a traditional 401k. Now, a traditional 401k is a popular type of retirement account that is set up through a business. Traditional 401ks have great tax benefits. For example, contributing to traditional 401ks are tax deductible. This means that every single dollar you invest into your 401k, you'll get an equivalent tax deduction. So if you invest $10,000 into your 401k, you'll get a $10,000 tax deduction. If you invest $15,000, you'll get a $15,000 deduction. In 2024, the maximum amount that you can invest is $23,000 into your 401k through an employer. Self-employed people can also have traditional 401ks. They just have to have what's called a solo traditional 401k. If you're self-employed and have a solo traditional 401k, then you can contribute up to $69,000 in 2024. So the contribution limits are actually even higher for self-employed people who have traditional 401ks. Traditional 401ks are a great tax deductible investment for both employees and qualifying self-employed people. So please do not overlook this tax strategy. Number 4 is a traditional IRA. Just like with traditional 401ks, traditional IRAs are tax deductible investments that help you save for retirement. An IRA stands for an individual retirement account. And the great thing about IRAs is that almost anyone can set one up. You don't have to set up an IRA through a job, your employer, or your business. You can set it up yourself with the help of a financial institution like Vanguard. Traditional IRAs work in the same way that traditional 401ks work when it comes to tax deductions. So just like for traditional 401ks, with traditional IRAs, you'll get a tax deduction that is equivalent to the dollar amount that you invest in your IRA during the year. However, keep in mind that contribution limits for traditional IRAs are significantly lower than the contribution limits for traditional 401ks. In fact, for 2024, the contribution limits for traditional IRAs are only $7,000. Let's jump to number 5. HSAs, or a health savings account. Health savings accounts are accounts that help you save for medical expenses in a tax-advantaged way. However, just like with retirement accounts, health savings accounts also have contribution limits. And in 2024, the contribution limits for HSAs are $4,150 for self-only coverage and $8,300 for family coverage. Once the money is in the account, it can be invested as long as you spend the money on qualified medical expenses. You will not be taxed on your withdrawals. So there are multiple tax advantages for health savings accounts. A wide variety of medical expenses can count as qualified medical expenses. For example, all of the following can potentially count as qualified medical expenses for an HSA: ambulance fees, allergy and sinus medication, crutches or canes, drug addiction treatment, hospital services, laboratory fees, medical monitoring and testing devices, office visits, prescription drugs, psychiatric care, surgeries, and many, many more. Considering the fact that tens of millions of people have medical expenses every single year, these accounts can be extremely beneficial for many United States-based taxpayers. We have covered a lot of information in today's video alone. Here are the key points that I want you to walk away with. Number 1, certain investments are eligible for tax deductions. You can use these investments to dramatically lower your taxable income and thus lower your taxes. Number 2, some of the best tax-deductible investments are real estate, oil and gas, traditional 401ks, HSAs, and IRAs. Number 3, the amount that you will be able to deduct on each of these investments depends on a number of factors, including the investment type, depreciation, rules, size of your investment, and much more. However, they all have the potential to reduce your taxes significantly. Now, before we end the video, I also want to remind you guys that my tax-free wealth event is just around the corner. It'll be taking place from March 18th through March 22nd. In this event, I'll be teaching the top tax strategies used by the wealthiest of Americans to save a fortune in taxes every single year. A lot of the information that I'll be sharing in this event, I don't cover on my YouTube channel for a reason. You can attend the event digitally if you would like to, anywhere in the world. And if you sign up for a VIP ticket, you'll be able to speak with me personally about your specific tax situation. So if you want to learn the absolute best tax strategies that I have that aren't on the internet yet, and you're serious about saving money and aligning yourself with a tax professional, I look forward to seeing you on that event. Without further ado, I will conclude this video. And I just want to say thank you guys for subscribing, following me, and being a part of the growth that we've experienced on this channel. You know what to do. Like, comment, subscribe, and I'll look forward to seeing you all on the next video. Cheers.